Welcome back to Chipstock Investor. We've decided that it's time to make some portfolio changes, and we wanted to share that with all of our viewers. So we're going to discuss some of the stocks that we're selling and some of the stocks we're adding to our portfolio in May of 2024. Before we jump into exactly what we're buying and selling, we're going to talk a little bit about Berkshire Hathaway and their most recent annual conference that was held on May 4th and 5th.
Yeah, that's right. We are longtime Berkshire Hathaway shareholders, BRK.B. Now, this is not a stock that we're buying, certainly not selling after the Investor Day and first quarter 2024 earnings update. It was a fantastic quarter. You can see the operating income, really big, significant year over year jump. We want to talk about this though, because whenever there's these annual Berkshire Hathaway events, many investors pore over Warren Buffett's comments, looking for hints about possible stock purchases, looking for stock advice, even though Buffett himself says that he does not provide stock picks. That's why you should probably just own Berkshire Hathaway stock like we do and a lot of other long-term minded investors do. Clues about the market, the economy, whether it's expensive or not expensive. Broaden your perspective and your view. Here's the ultimate takeaway. This is all you need to know. This is the one and only lesson you need to know from Warren Buffett. Investing is all about being consistently moderate over the long term. Chop off the periods of frenzied market buying and then lop off the bottoms when people are in a frenzy selling, and do it for the long term, like many decades. It's incredible, but Berkshire Hathaway was taken over by Buffett and Charlie Munger 60 years ago, 1964. The key to Warren Buffett's success is not making the world's greatest stock picks. The key to Warren Buffett's success is just that, sticking to a philosophy, an investment strategy, a framework, whatever you want to call it, and doing it for a very long time. And that's what we aim to do here as well. No nonsense, focus on high quality business models and buy them with the intention of holding them for the very long term. But adjustments need to be made along the way. Not saying that all our investment decisions are going to be perfect. In fact, we've made lots of really bad ones. So that's what we aim for. That's the lesson in our view anyways. And if you really like Warren Buffett, just again, buy the stock, buy Berkshire Hathaway stock and forget about it.
With that said, let's talk about two companies that we've decided to release from our portfolio. We'll start with the first one, Twilio.
Yes, kind of hard to believe. We've actually owned this for almost 5 years now. Nibbled on it a few times, including after the bear market started and the stock got clobbered. I think our last purchase was like in the $40 range. And it's time to admit that our original thesis for buying this company is bust. Our thesis has now been whittled down to just, it's a great buyout candidate. The right private equity company or the right larger tech company can probably turn this thing into a profitable asset. That was not part of our original thesis. By the time you see this video, Twilio's first quarter 2024 earnings update has probably already been released. They're releasing the evening of May 7th. So we're telling you all of this before we actually do it. We're going to see what that report has to say. And if we just get more confirmation that this business is busted, it's time to just take the tax loss harvest now and reinvest it somewhere that is growing.
Let's move on to, I would say, arguably a bigger deal for us in selling Marvell technology stock. We've been invested in this for quite some time now, and we've been pretty confident in this company. So why are we selling Marvell technology at this point?
Be fair, Casey, I think we should mention we're probably going to do a reverse dollar cost average sell on this one. We talked about that with the when to sell NVIDIA stock a few weeks ago. Dollar cost averaging is when you buy the same dollar amount of a stock on an automated schedule, maybe once a month, once a quarter, or whatever. Dollar cost selling is exactly the opposite of that. Maybe you decide you want to exit a position over the course of, in our case, let's say 6 months. And so maybe we just sell this in batches over the course of the next 6 months. May 30th, in just a few weeks, we'll have a Marvell update. And we do want to own at least some of our position when that report comes out. This company has merely performed the semiconductor industry average at best over the last going on almost 6 years now since we made our initial purchase. Pretty simple. So what we've been doing is we've been trying to figure out, why is that? Why is this best just performing with your average large cap semiconductor stock as measured by SOX, iShares Semiconductor ETF, or SMH, the VanEck Semiconductor ETF.
We'll, of course, explain a little bit more about why we're doing this, why we're exiting Marvell technology over the next 6 months or so in upcoming videos. And you may be aware of our hesitancy and our hold status on Marvell technology based on some of our recent videos, which we'll link in the description as well as here on video. But let's shift now to what we'll be doing with the proceeds from Twilio and Marvell Technology Group.
Yeah, and the very first pick, and the stock that will probably gobble up most of, maybe let's say half or more of the proceeds from both of those sales, probably provides the biggest hint as to why we have come to feel the way we feel. That's Broadcom.
I think you've told me before that when you're purchasing a stock and looking at the competitors, is there enough compelling evidence to purchase the smaller company versus the leader in the market? And that's why we have been following Broadcom and why it's ending up on this purchase list after selling a company like Marvell.
Yeah, that's right. And we've actually owned Broadcom even longer than we've owned Marvell. And it's not even a close comparison. In business performance and in stock price performance, the total return for Broadcom is through the roof. Now, one of the more recent videos that we did on Broadcom, we called out the risk that Broadcom's strategy of acquiring all of these assets and whittling them down to their most profitable core, letting the most unprofitable parts of those acquisitions go, does have risk. And perhaps Broadcom could be like the next GE of the tech industry. But maybe that's a little unfair because there's also a possibility that this has a very, very different outcome 10, 20, 30 years down the road.
Or Broadcom could become the next Berkshire Hathaway. You see that Broadcom has a long history of acquisitions, especially after it became Broadcom in 2016. They've increasingly diversified the business with its most recent acquisition of VMware in 2023. This is why we draw the General Electric comparison.
And it's certainly not a perfect analogy because Buffett and company take a much more passive role when they acquire businesses. Hock Tan, CEO of Broadcom, very, very different strategy all along the way with those acquisitions, even before becoming Broadcom in its current form as we know it today, has been to acquire these different assets and first focus them down on their core competency. So at this point, there's a couple dozen of these little segmented semiconductor design houses, a little bit of manufacturing in-house, and then of course the infrastructure software services. But once they get them whittled down to that profitable core, Broadcom's more than happy to sit on that, collect the profits, return some of it to shareholders via dividends and stock buybacks, and then go on the hunt for more acquisitions. This latest one of VMware, obviously one of the largest technology acquisitions in history. But overall, we can see the strategy working very, very well. It's really incredible. And I don't think probably not getting talked about enough that Tan and company mentioned on the Q1 2024 earnings call that VMware is going to grow at a mid-teens percentage pace sequentially for the rest of this year for in each of the following quarters. VMware was a stagnant, non-growth, not all that profitable software enterprise in recent years under former CEO Pat Gelsinger, who you probably now know is the CEO of Intel. And then after he left and returned to Intel, VMware was just not a great asset. Suddenly it's in high growth mode and they're turning it profitable. And also, as it turns out, Broadcom has these old semiconductor assets that it acquired many years ago that are suddenly being refreshed and repurposed for networking to help address the AI supercycle, more than offsetting some of the not so great expected performance in the semiconductor business in 2024. This has been a fantastic business. It's very clear to us now that Broadcom has the right mix of assets for this market that makes it what we think will probably be a superior investment for the very long term, not just for this current AI supercycle that we're looking at in the next 3 to 5 years.
So our plan is to use half of our proceeds from the sale of those two companies and purchase more Broadcom stock. Let's take a look at some of the other companies that we use with the leftovers from the proceeds. We have two big tech giants that we're going to continue nibbling more on. Tell us about that, Nick.
Yeah, the first one, of course, you're very familiar with if you've been watching the show. We called Amazon one of our top stock picks of 2024 back in December. And then again in January. This is one that we've been slowly building and scaling into for over a year now. And unfortunately, given this market where it looks like the Fed is going to continue keeping interest rates higher for longer, this is an economic environment that really favors large cap businesses, very large dominant businesses that are able to increase their profit margins. That's what this market is looking for. That's what collectively investors are looking for. Profitable, highly profitable, and increasing profit margins. Amazon very obviously checks both of those boxes. So whether it's the e-commerce business or if it's AWS, the cloud computing infrastructure side of the business, Amazon is actually increasing profit margins on both sides right now. That's a very, very powerful position for them to be in.
Is it the same story with Meta? That's the other tech giant that we're looking at increasing our position in. Maybe some of you missed the video that we recently did on Meta. The market seemed pretty scared about all of the CapEx spending that they're going to be using over the next several years in their AI servers. But we still believe this is a growth business.
Absolutely. It's funny how the market kind of swings back and forth like a pendulum. Again, goes back to that needing to be consistently moderate in your habit. It was like less than 2 years ago that large chunks of the investment community thought Meta was dead and done for. Nobody was going to use Facebook or Instagram anymore, even though, having 3 billion plus monthly average users is an incredibly powerful position to be in. So it was actually about 2 years ago in the throes of the bear market when we last added to our Meta position. We think now is an appropriate time. The market has de-risked Meta stock a bit because of that CapEx spending that you mentioned, Casey. But if you're part of our Discord community, or if you follow along with some of the supplementary articles that we also post on our community board, you probably understand how we feel about this, that Meta is most definitely monetizing those AI investments just by simply plugging those AI algorithms into its own home-cooked ad algorithms that it feeds its users. In addition to that, it can also pull on the operating leverage arm by just getting better at cleaning up the Reality Labs segment. That's the segment that houses the Oculus, what used to be called the Oculus headsets. We, again, talked about this more over on our Discord channel, about them opening up that as a third-party ecosystem to help build out this virtual reality business. And it really, if you look at what they're doing, it goes well beyond just video games. We think getting third parties involved is another way Meta can help turn that business around from, a very, very large operating loss every year. We're looking at 16 billion plus in operating losses this year just from Reality Labs. We don't think it'll take much within the next 2 years to start turning that ship around and increasing those profit margins as well. So you're absolutely right, Casey. This is most definitely, in our viewpoint, maybe a slower, more gradual growth business, but an operating profit margin expansion story, which is what we think the market is looking for given the current state of the economy.
So earlier this year, we talked about customer relationship companies, software companies, Salesforce and ServiceNow. And we've owned Salesforce for quite some time. We've added to the position. We have not purchased any ServiceNow, but I noticed that we are actually going to be purchasing UiPath versus the other two, ServiceNow or Salesforce, with our proceeds. Why UiPath at this point?
Yeah, Casey, we've owned Salesforce now for coming up on a decade. It's not going to be too much longer before we can say it's been a decade of ownership. It's another one where the pendulum has swung from one extreme to the next. We sort of put any further Salesforce purchases on hold when it got off to a very hot 20% run in the first 2-3 months of the year. We never bought ServiceNow for exactly the same reason, and we don't want to chase. There does come a point where valuation does start to look a little bit stretched. And sure enough, both stocks have sold off just a little bit since then. But we have Salesforce. It's one of our core holdings. We don't need to add more to it, but we do still like and want to have some small cap business, especially software business positions in our portfolio. If you've been following along with us for a long time, UiPath is one of those, say, smaller. It's not a small cap stock by the traditional metric, but it's definitely a smaller software business when you compare it to some of its peers. We'd like to add a bit to our position because it sold off, went in the opposite direction. It's down 20% from its most recent peaks just a couple of months ago.
UiPath is an automation software primarily, all sorts of products and services to help their customers manage their workflows and to automate tasks. We can talk about AI being a huge factor in all of these companies, really, but the reason that we're interested in UiPath is their increasing profit margins.
Yeah, things really started to take a positive turn last summer. We talked about this last summer more in depth when they brought in a new CEO and then the former CEO, co-founder, Daniel Dinesh. I'm sorry, my Romanian is rusty, but went back to being the chief technology officer. It's a great move. We like the trajectory the business is in. And again, it's part of our small cap stock basket where we have a couple dozen of these at any given time. And we like where it's sitting right now after the pullback.
Okay, let's talk about our digital payments space in our portfolio. We got rid of PayPal early this year. You may remember that video. We still hold Block, much to my resistance, I'll say, but it looks like we're going to be adding a little bit more of Shift4.
Casey, I think we're just repeating the same thesis here over and over again at this point, but it seems really absurd that Shift4 Payments has strung together a few very, very good earnings reports. Obviously, they're growing. They're integrating some new acquisitions to expand into Europe. They're profitable on many counts, and it looks like the management team is focused on continuously increasing those profit margins. But it appears that the market had run up the stock price because of a potential buyout. Shift4's management founder, Jared Isaacman, comes out and says, those bids were not appropriate. They didn't fully value Shift4's future potential. It sounds like Fiserv was maybe one of the leading candidates to take over. Shift4 says no thanks. Stock price collapses. I think we'll nibble. We'll add just a bit more to our position here after this pullback and the long term.
Okay. Last stock that we're purchasing with those proceeds, AppLovin. What does AppLovin do?
Another software company. This is one we're going to buy a very small position in just to kind of earmark it for more attention in our portfolio. We want to see how 2024 unfolds for the business. But again, it's just the same thing. It's digital advertising. It's a mobile video game studio, or studios, I should say, plural. And yet the story has been this new AI product that they have, this new AI platform that's driving growth in the advertising side of the business. But also, again, more importantly, along with that growth, massive increases in profit margins. The management, which is founder-led, has been repurchasing lots of stock with that newfound profitability. So this is one we want to finally, we've been talking about it here for several quarters at least. We're going to buy a very small position, earmark it for more attention, and see how it goes as the year progresses. And then, as well as adding AppLovin as a new stock in our portfolio, we also just want some cash left over in the next 3 to 6 months. For some of the dollar cost average companies that we've been talking about, we're getting to a point here where the second half of 2024 seems like a big inflection point for the semiconductor market for manufacturing. And so 2 of those companies that we continue to nibble on throughout the downturn, we just talked about in our last video. That's companies like Axcelis Technologies, ACLS. We want to be able to have enough cash in the coming quarter or 2 to be able to continuously add to those positions and build them up to a full portfolio position as we head into the back half of 2024 and 2025, when we're expected to have a very, very large growth super cycle for semiconductor fab construction.
So there you have it. This is why we're selling our positions in Twilio and then Marvell Technology over the next few months, and some of the positions that we're adding to in the coming weeks. Some of these companies, maybe we have not spent a ton of time on videos in, but we do spend a fair amount of time on our Discord channel discussing these companies and many more. So if you are interested in a membership and Discord access, you can find that here on the join button here on YouTube or over on our Ko-fi page. Just $5 a month gets you all of our show notes, all of our manuals, and a ton of chat with a great community of investors. Please subscribe to the channel if you haven't already. That's a free and easy way to support us here on YouTube. We really appreciate it. We'll be back with more later this week at Chipstock Investor.